Okay.
Thank you.
So please keep profanity to a minimum.
Your presentation, sir.
All right, here I go. Let me turn this on again. Presenter view.
And last question, or sorry, Al, last thing before you can get going. Hey, if there's any questions for Al, you can just populate them in the voice channel, and when he's done, I can start rifling them off, or you guys can open your mics and talk to you. So, just as anything comes up.
Okay. Here, screen 3. Go live. All right. So here we are tonight. Thank you guys for showing up, or ladies, if there are any. Let me just start off by thanking Paul and Taylor for giving me this chance to share my knowledge and experience. I hope it resonates with you guys, and that's it. So once again, thanks Gamma Edge. For me personally, Gamma Edge has raised the bar for option traders as services go, and have been a definite factor in my ability to take my trading to another level. So I'm grateful for that. And if you think I'm kissing ass, not at all. Paul just wired me $20. So that's a joke, by the way. Okie. That went well. No reaction. I hear the crickets.
I'm laughing.
I just don't want to interrupt
I'm
you.
laughing too. I just
Okay,
wanted
okay,
to,
all
We're
right.
all laughing, but we're on mute.
Oh, okay. All right. Okay. So yes. So when I was approached, I thought about different topics, and I've done other presentations in the past for other trader clubs here in Montreal, and during when I was working on my algorithmic trading project, I had done different presentations and stuff. But I wanted to choose one that was basically that could appeal to all kinds of traders. I didn't want to do a presentation where I'm evangelizing a specific style and stuff, because that's open for debate, and rightfully, and it should. That's what makes a market. So I decided on going with something there's very little debate. Math doesn't lie. So I came up with this topic called Easy Math and Hard Profits, a little pun there. And therefore, that's it. So here we go. Let's go with the next slide. Let me choose. There we go. Okay. So the overview, the math never lies. That's basically the meat and potatoes of the presentation. The proof is in the pudding. I'll be sharing my results from before Gamma Edge and after Gamma Edge, about a month and a half, because I started with Gamma Edge beginning of February. And the third, think yourself as a professional athlete. I'll be using a simple analogy to kind of as an intro to describe my trading style and routine. Some takeaways, food for thought, and some useful links that I use, and either for the presentation, do a little bit of research, and on my daily, as part of my daily routine. So if you have any questions, this is a presentation, but I'd like for it to be interactive. So if you have any questions, don't feel free to cut in, and I'll just tell you to wait till the end. I'm joking. No, you can ask me and I'll stop. And so I want this to be interactive. I just don't want to speak for 20 minutes and by myself. I want this to be an exchange. I think that's when those are the best presentations. So here we go. The math never lies. Okay, this here is R. We sometimes hear about R and R multiples. So I'm just going to take some time to explain what this is. R is basically risk, and the R multiple is the reward. So if you want to have a positive expected value, which is the goal, no, if you want to make money over the long term, you have to have a positive expected value. Now, a positive implies that there's a break even somewhere. So this basically tells you where your break even needs to be in order, and everything above your break even is your expected value, or your net positive expected value. So as a basic example, you see my mouse moving, right, on the screen? Yes. Okay, cool. So an example number one. So buy to open an SPX call for $1. So that means that your risk is $1 because you're buying to open. You're long an option. So your risk is limited to what you paid, that $1. If your objective is an R multiple of $3, you need to have a win rate of 25% to have a positive expected value. So, and the example, so you basically, it's like rolling the die or flipping a coin on a 50-50. On the first toss, first trade, you lose $1. L means loss. Lose $1. Second trade, you lose $1. Third trade, you lose $1. And on the fourth trade, you make $1. Win $1, win $3, sorry. And therefore yours break even. And as we see it here on the right-hand side, your R multiple is 3. Your required win rate is 25%. And here's the general formula. It's 1 divided by 1 plus R. So 1 divided by 1 plus R multiple was 3. So that's 4. So 1 divided by 4 is 0.25. And that's what you get here. Sorry, here, 0.25 or 0.25. Any questions? Nope. Okay. Or here's a second example. Example number 2. Sell to open. You sell an SPX $5 put spread for $1, which means your risk is 4. Remember, it's a $5 spread, and your max loss is equal to the width of the spread minus the premium you collected. So you're risking $4 to make 1. This is basically somewhat the opposite. Here you're buying an option, here you're selling an option spread. The objective is an R multiple of 50 cents. Oh, sorry, no, of 0.5. You will need to have a win rate of greater than 67%. The reason I put the plus is because here, this doesn't factor in commissions. So if you factor in commissions, you obviously need to be greater than 67, maybe 68 or something. But it's, so technically it's more than 67. To have a positive expected value. For example, on the first trade, you lose $4. On the second one, you win $2. And on the third one, you win $2. Okay. Now our multiple of, so if we go here to 0.5, you'll see that you require a win rate of 67%, which is 2/3 of the time. You have 3 trades and you want 2 of them out of 3, which is 2/3. So this is just a very simple formula to help you. So, well, no, if you get into a trade and you're risking, you're buying a put or any long option for a certain amount, you know what you need, your objectives. Well, how much do I need to get? Because that is a hard question sometimes to answer. You get into a trade and you buy it, and then we don't know where you're getting out. I don't know. No, what's my exit? I don't know. Well, you gotta know. No, that's part of the plan. You have to know your entry is only one, is actually the easiest thing to do. The planning for your exit is the hardest part, and you have to know this. This is part of your plan. So if you want to be consistent or try to maintain a certain level of consistency, you have to plan for your exit before you get into the trade. And how much you take depends on what your risk is. So if you're betting $1 and you want to take $1 profit, you buy for 10 and you want to get out for 20, which is an R of 1, R multiple of 1, then you just need to be right half the time, which makes sense, like flipping a coin. You flip it twice, you got to be right at least once to break even. Any questions? No? Okay, I guess it's... so that's the basic formula. The next one. Probability of streaks. This is a simple one. Based on your win rate, because here in the previous one, we started with the win rate. And now, if you have let's take a simple one. If you have a win rate of 50, what are the probabilities of having, let's say, 2 losing streaks, or losing 3 trades in a row, 4 trades in a row, 5 trades in a row? So first trade, obviously, if it's 50-50, you have 50% chance of losing. After 2 trades, the probability of having 2 losing streaks, a streak of 2 losing trades is 25%, because there are 4 possible scenarios. You win and you lose on the second, you win, you lose, and you lose and win. So there's only 1 out of 4 where you actually have a lose. And you keep going, and therefore on the third, it'll be also times 0.25. And therefore, here they rounded it out, but it's actually 0.125. So, and he keeps going. So example number 1, 30% times 0.3 is 9%. I already did here. If you take that 0.3 times 0.3, you get to 0.08 times 0.3, 0.02. Now, on a 0.3, it's a little difficult, but on the 0.5, it's much easier to visualize. You're basically dividing by 2. 50 times 0.5 is 0.25. Divide that by 2 is 12.5. Divided by 2, 6.5. Divided by 2, 3%, and it keeps going. So this tells you basically what your probabilities of having a bad streak is. And it makes sense, no? So the higher your win rate, the less there is of a probability of having 2, 3, 4, or 5 losing trades in a row. 0.2% versus 17% if your win rate is only 30%. That's... Any questions?
No, but since you said you wanted it to be interactive, let's start interacting.
Sure.
Can you go back to the previous screen for a second, Al?
Sure.
So I understand this math, and I understand the probabilities, but you and I both know gamblers have gone and said, well, I'm going to gamble and eventually it's going to work. And it doesn't, and they become broke. So
Because they're gamblers. They're not traders. You said it.
okay, yeah. So the distinction, as I was listening to you, I said, to me, the distinction is, well, let's say you do get in a bad rut. The distinction, I think, and I'd like to get your opinion on this, is that if it doesn't work out in this way, then the problem isn't with the probabilities. The problem is with your plan, like the reason why you got in the trade, the reason why you stayed in the trade, and the reason why you didn't get out of the trade. Correct?
Correct. Yes. If it falls apart, if you're losing money, there are many ways of losing money. Yes, I agree. Something is wrong with your plan. You have to go to the drawing board and see, okay, I usually go on tilt peak after 4 losing trades in a row. And I'm just coming up with this right now. So you asked me a question and I'm kind of improvising and just thinking as we're doing the presentation. So I would say if I go on tilt after 5 consecutive losses, And then I would say, okay, well, what's my win rate? Maybe it makes sense. Maybe it's normal for me to lose 5 consecutive losses, and I go back. Okay, what's my win rate? My win rate. And he goes, what's 30%? He goes, well, that's 70. No, it's my odds of losing 5 in a row with a win rate of 30 is pretty high. So there shouldn't. So I think when you start understanding the math, or you look deeper into your statistics, your trading stats, that can help you understand why. And when we understand why, I think it helps appease your emotions. It helps you, it calms you down, and you don't go as much on tilt, because you know why. And therefore that could lead to 2 things. Either you understand and you accept the losses, or if you still cannot accept them, then you change trading strategy so that your win rate is 50%, and therefore the probabilities of having 5 consecutive losses is 3% versus 17%. And therefore maybe the most you'll get is maybe 3 losing consecutive losses, which is less, which is 13% probability versus 17, and you might not get on tilt at 3 consecutive losses. So there's an exercise. I think the important thing is, I hate losing. I think it's what keeps me in the game, and I think all of us hate losing. And I think the fact that we're here still trading is because we're tenacious. Some people would say stubborn, but I like to put a positive spin to it. My glass is half full. We're tenacious. We don't give up, and we look for alternative solutions. We always go back to the drawing board, just like an athlete, a gymnast, no, or a diver, no. Paul can relate to that. You miss something, you go back to the drawing board. You go back to your coach and say, what can I improve? And you go, this is not working for me. I got to try something else. So I think the math doesn't necessarily turn a gambler into a winner unless he or she decides to put the conscious effort to look into the why. Why am I losing? Why? Yeah, that's my answer. You got to dig deeper. I don't know if I answered your question.
Absolutely. Thank you.
So, and I think the math is maybe like our kind of a trader's shrink, type of shrink in a way, because the math gives you the answers, but you got to take the time to look at it. That's why. Great. Thanks for the question. Great question. Thanks. Okay, here's another slide, and this is somehow related, because if you notice, there's a little continuous theme. No, so we start with the win rate. We look at the win rate across consecutive losses, and here we look at the consecutive losses versus the amount of risk per trade. So 10 losing trades in a row with an R of 1% equates to about the same drawdown, 9.6 versus 9.8, as 2 consecutive losses of 5%. Again, this is something along the same theme that you asked previously. Sorry, I don't know your name. I couldn't see your who asked the question? Ball Crush. Oh, okay. I didn't see his avatar light up or something, so I was a little blind. Okay, not a problem. Not a problem. So here, if you're, and I think this is one of the basic, but yet least understood, or maybe not as consciously in the forefront of trading as it should be. The amount of risk that people trade, they put on every trade. So basically, if you put 1% of your capital on a trade and you lose 10 times in a row, you've only lost 9.6%. of your total portfolio, capital. However, if you're risking 5%, after 2 trades, you're already at 9.8. So, and the next slide will show you how difficult it is to recuperate. So if you take the extreme example, if you're risking 50% of your capital, basically, after 2 trades, you're bankrupt. You've lost. And we know that 2 trades, having 2 consecutive losing trades, depending on your win rate, is very plausible. At 30% is 49%. So you basically have 50% chance of going bankrupt after 2 trades if you're risking this much, 5% per trade. And so this is just a simple table. And here's a little, I did this on the side on the spreadsheet, the probability of consecutive losses. So 1 in 2, 1 in 4, 1 in 8. Actually, it's kind of what I put here, but I just extended it. And if you think about it, 10 consecutive losses is 1 in 20, 1 in 1,000, basically. So you got to be, if you're able to lose 10 trades in a row, I would politely say do something else, or change your style, because something is definitely wrong. So this is a simple slide, but again, the goal is to visualize, to help you understand the why, or yes, to understand the why.
Hey, Al, I want to
This,
step in real quick.
yeah, sure, go
So
ahead.
I think,
No, step in anytime. Yeah,
I think kind of one of the big overall themes is like, as a trader, we should be treating this as a business, and we should be tracking these stats, right? Each trade, you should be journaling what happens so you understand these stats, right? So it's kind of like
yes,
if you're a business, you have a profit and loss statement. Well, as a trader, it's your business. You need to have the same profit and loss statement so you understand these statistics in your trading. Because to your point out, like if you're having 5, 10 losses in a row, well, that should be very evident looking at your trading, at your journaling, and you should be thinking to yourself, what am I doing? Why am I losing so much? Is my style just not, it just doesn't jive with the current environment? So yeah, at the end of the day, I just think it's important that we should be knowing these kind of stats in our system to ultimately determine if we have edge in the market or not.
absolutely, 110%. You should treat it like a business. Before I got into trading full time, I had my own software consulting firm for about 25 years, and it was a business. You make forecasts at the beginning of the year, you revenue forecasts, you forecast your expenses, and you have a P&L, and trading is the same. You have revenue or potential revenue. How much do you want to make? No, first of all, you have costs. Commissions and slippage. Those are more subtle. Those are they would be called variable costs. And then you have fixed costs. If you have a computer, a server, subscriptions to different services and stuff, those are your fixed costs. And then you have to say, well, how much? So let's say your fixed costs are $500 a month for everything. So he says, okay, how much do I need to make? And you kind of reverse engineer your objectives, because you have to have objectives. No, trading without a plan, you might as well, no, I'll take your money, no, and I'm sure everyone else will take your money. And that's what the market is. There are plenty of people that are willing to take your money, and they do most of the time. Hopefully you're on the other side. You're the one that's taking people's money, but you got to have a business plan. So you have your costs. Let's say it's $500 a month, and it says, okay, well, no, you have, let's say 10K as your trading capital, as an example. So $500. No, you got to make 10%. 10% would be 1,000. You got to make 5% to break even. So then you have to figure out, okay, you break it down. 20. That's 20%. That's 5%. There are about 21. Let's just say 20. There's actually 21 trading days in a month on average. So let's $500. You got 20 trading days. Again, you have to make about $25 a month, a day trading with $10,000 in capital. Let me just take out I'm doing this in my head. Hopefully I don't get it all wrong. But I think here, I'm doing a little calculation here. Let me bring it on the screen. So if you go 500 divided by 20, there you go, 25. So you need to make $25, and $25 divided by 10,000, it's 0.0025 per day. So it's basically 0.25%. Now, can you make 0.25%? That's a break even. And let's say you want to have an objective of making $1,000 a month. So $1,000 a month, that's 10%. We know 1,000 divided by 20 trading days, it's $50 a month. 50 divided by 10,000, it's 5% a day. Does it make sense? 5%, yeah. But yeah, one would be 1%. It's 0.5%. 0.5% a day. Are you able to make 0.5% a day? Or what are you trying to do right now? So again, 0.5, and you kind of reverse engineer it. So if we go back to this slide here, when we're talking about our multiple, if you enter a trade for $1, and remember there's a multiple of 100, so this is basically $100. Let's bring out our little fancy calculator here, calculus calculator, or HP. I don't know. There's some nerdy calculator model out there. Our fathers all used to have. The engineers probably know what I'm talking about. So let's do the math here. So you have 10,000. You're risking. How much do you need to risk per day? And I'm just doing this on the fly. So you need to make 5%. Sorry. 10,000 times 0.005. Hold on a second here. Let me start over. We said that your objective was $5, $25 a day, to make $500 profit a month. Okay, so you basically have to risk, if you're doing a trade here, $25, 100, you need a 0.5. You'd sell for $1.25. So basically you're looking for an R of 0.25. 0.25. Does that make sense? Okay, let's do even simple. An R of 1. You bought for $1. Our multiple is 100. If you're doing, you're looking for an R of 1. You made $100 for the day. Now $100 divided by 10,000, you made 1%. So you basically, this is 4 times your revenue, but you have to make 0.25% per day to make your objective of $1,000 a month with $10,000 of capital. It seems attainable. The problem is, and it's very attainable, the problem is, in my opinion, is that people want to double their account every month, every 2 weeks. Which is not realistically, when you look at the stats. The stats are against you because of the nature of the business, no? So, yes, to get back to Taylor's question, you have to treat it like a business. Absolutely. Okay. So this is where we were. Any other points, questions for now? No? Okay. Now, leading up to this, so this tells you basically the losing streaks and how much capital you expect to lose if you risk that amount. Moving forward. So if you do lose 10%, Again, there's a continuation theme to all these slides. We're building on it. If you do lose 10%, because you're risking 5% on every trade, that 10% will require you to make 11.1% on your remaining 90% of capital to get back to even. So if you start off with $100, you lose $1,000, you're down to 9,000. You got to make 11.1% on that remaining 9,000 to get back to your 100%. So the drawdown is the percentage off the high. If you're starting off with 10,000, then your high is your 10,000. Example number one, $10,000 times 5%, you lose $500. 500 divided by 9.5, which is what's remaining, is equal to 5.26 or 5.26%, which is what you got here. Example number two, you lose 20%, that's $2,000. $2,000 divided by 8, it's 0.2. And you need 25% to make, which makes sense. So if you lose 20%, you need to make 25% on the remaining 8,000 to get back to even. And here, no, let's hope this doesn't happen. But if you lose half of it, this is an easy example to understand. If you lose half of it, then you need to make 100% on your remaining 50% in order to get back to even. So you can very easily see how the little things pile up and can snowball into something that is unrecoverable. You didn't properly exit your trades because you didn't have a plan. You probably have a wrong strategy, which gives you a low win rate, and therefore any amount of consecutive losses piles up. And then you start getting a little bit on tilt, and you start taking more risks, which only adds to your drawdown. And you get to a point where you just you'll never be able to recuperate, and then you just YOLO and you lose it all. So yes, so that can help. Reverse engineering with these simple formulas can help you stay out of the pit, so to speak, the lava pit. Excuse me. And this is the last, almost second to last slide. Your expected return on capital per trade. The goal is greater than 0. The expectancy. What do you expect to make based on 3 variables: the win rate, your position size, and your R multiple? If you notice, these are things that we've just seen in the previous slides: your win rate, your position size, which is this here, the risk, and your R multiple, which we saw at the beginning. And therefore, your trade expectancy, if we take a simple example, your win rate is 0.55. Actually, let's do it's example number 2. It's pretty easy. Your win rate is 50%, like flipping a coin. You risk 2% on every trade, and you're only looking to an R of 1. So basically, this comes out to 0, which means that your break-even point is an R of 1, which is exactly what we came up over here. R of 1 is 50%. It's another way of presenting basically the same formula. If you have a win rate of 0.25 and you're risking 2% of your capital, but you have an R multiple of 3, this is what you get on this side of the equation, and on the other side of the equation, this is this. And you subtract the both, and it's 0. So this basically tells you that that is your break-even point. Again, 25% R multiple of 3, 25% R multiple of 3. So it's basically the same thing, but a little more expanded from a calculation point of view. So this basically tells you, if we go back to the example on the slide, if your win rate is 55, you risk 2%, and you have an R of 1.5, that's 0.1, 0.165 is the left-hand side of the equation. Here we have this side, and you subtract one from the other. It tells you that you have a positive expectancy of 0.75, and this is what you're looking for. Basically, this is your winning formula. So if you have a win rate of 55 and you're risking 2, you should be aiming for an R multiple of 1.5. You get in for $1, you get out for $1.50. You get in for $3, you get out for $4.50. Looking for 50% return on every trade. And that's because your expectancy rate is 0.55. So this is basically what the math that what Taylor talked about, treating it as a business and going back and analyzing your trades. This is what you're aiming for. You want a positive expectancy. And this is the simple formula to tell you if, based on your past trades, this will tell you if you're on the right path or not. And the last slide of this, the exponential growth. Once you have the winning trade, you're on the winning track based on your expectancy. Then you say, well, if I can trade that expectancy, what is the exponential growth? In other words, the power of compounding. If you notice, this is the same example, actually almost the same example as in the previous slide. I changed the R multiple from 1.5 to 2. This gives us a 1.3% expectancy rate. So one trade, 1.3. After 10 trades, your 11th trade will give you 146.03 because you're compounding. So I won't go through all the math. Oh, I got an extra period here, decimal. But the idea is that it compounds. So you're always 10 plus 130 goes 10 130 times this, and you keep adding. And so this is the power of compounding, and that's what you want. So you go from if we start from the beginning, a very quick recap. You have your R multiple, the probabilities of consecutive losses, those losing streaks times the loss of capital per trade, what you're risking, or some people call it the VAR, the value at risk. Your drawdowns, and then here you say, oh shit, I gotta rethink my plan because it's not working. You figure it out, and then you're back on the winning track with a positive expectancy, and then based on that positive expectancy over X number of trades, this is what you should expect to gain. And this, in a way, all this has to be should be part of your business plan, as Tyler mentioned. So this is the meat and potatoes of the presentation. There's a little more to go. The rest is just maybe a bit of blah blah, and there'll probably be some more open discussion and questions coming up. But this is what it is. Any questions so far on this?
Hey, Al, Paul here. Can you
Yes.
comment at all on how you become consistent so that the numbers you're talking about in context of expectancy and everything are, approaching, some stability? Can you, yeah, so exactly. So when you're coming up with that expectation and your win rates, in my personal experience, it's based upon how consistent you can execute your strategy. Can you talk a little bit about your mindset and how you manage that part?
Okay. Excellent question. Consistency. When you said that, the first thing that came to mind was that analogy about the chicken and the egg, which came first. It's hard to describe because I think they both come at the same time. It's kind of a symbiotic relationship because you say, well, how do I develop consistency? Well, with a winning formula. But how do I get a winning formula if I don't have the consistency, no. So I think it has to do with doing your homework, no, not being content with your results and not getting discouraged and being no tenacious / stubborn, and not accepting defeat. You have to go back to the drawing board. You don't know how many times I've gone back to the drawing board because every time I thought I was figuring something out, example, when I was doing my algo trading, and I would come up with something and I would run a back test, and then I go, and I said, and there was a flaw in it, and it was no, it's something. It didn't last more. The winning streak, the expectancy didn't last more than 3 months. I go, okay, what am I missing here? And so it's that I think it comes within you. It's an integral part of your personality, and I think that's what's required to be a successful trader and get that consistency is the ability to or no, on the opposite side, the lack of ability to accept what it is. No, you don't give up. You go back to the board. You train. You don't accept defeat. No, you get up every time you fall down. You sometimes it could be demoralizing, and sometimes you need a break, and a break is required. So I think how do you get to that consistency? By going back to the drawing board, by not giving up, just no basic hard work and sweat and sometimes tears and
Sure.
a few extra keyboards on the side. Just
No, thank you. I appreciate
I
that.
don't know if I answered your question or was it too wishy-washy. No.
Well, I think no, I think you did answer it. I know, and myself included, style drift will move your expectancy numbers because, when something doesn't work after 2 trades, for instance, I always find myself wanting to tweak it. And as you, I think, have demonstrated here, 2 trades isn't really enough to gauge if you're on the right path or not. And so I was curious on how when you put this math to work, and you obviously do that. I mean, we talk about your 0.44 all the time. I'm just curious if you can convey to the others and myself, of course, how you stay on track, how you stay disciplined and don't have style drift, or don't try to necessarily get out over the tips of your skis. But no, I think you said it's right. It's right. Keep going back to the drawing board if things aren't wild, the chicken and the egg thing. But I think once you get something, you can improve on it. But how do you, Albert, how do you do that?
Well, how do I avoid getting over my skis from falling? I think knowledge is power. A lot of times, and I've listened to some what's the name? Steenberger Barger, psychologist, like his videos,
Yep.
and emotions. I think comes out of no, fear comes out of lack of knowledge to a certain extent. It's the unknown that scares us to a larger extent. And therefore, I believe that knowledge is power. So the more I know about my trades, the more I know about where I went wrong in the past. I think this helps me stay calm. And when you're calm, you think more rationally, and therefore you have a better tendency to stick to your plan. So I think it all starts with the passion that's inside of you to succeed, not to give up, and then that kind of allows you to do your homework, to do the math, because the math it never lies, and that gives you confidence. So I think it's not one thing, but it's a chain of events that kind of builds on each other. So knowledge gives you confidence. Confidence helps you stay more calm. Staying calm allows you to follow your plan, and that plan no yields positive returns, no positive EVE and growth, and that feedback, we often talk about reflexive trades or feedback loops, and that feeds back into confidence and slowly, hopefully. But yes, once in a while we'll have a bad day. Nothing is going right, no matter how hard you try to stick to a plan. And you say, oops, I was about to swear. It's being recorded. But you say, screw this plan. No, and you go full tilt, and then you go, what did I do? Why did I no? So you'll spend like months slowly grinding up Everest, that mount, as a metaphor, and then in a flash you'll just one bad step, and then you just slide down and get back to base camp. So it's not
Right.
easy. It's not easy. Of course, it's not easy. If it was easy, probably I don't know. But you're right. But I think it's not one specific thing. It's a different things done uh, slowly that cause a domino effect that gives you that exponent. And to a certain extent, you got to put in the screen time.
Yeah.
So, and this kind of goes to the next part of the presentation, which is my routine. I try to keep it simple, and I think keeping things simple helps with the confidence, because the brain is like a sponge. It can only take so much information, and therefore I try to limit the quantity of information and focus on the quality of information that I'm trying to absorb. So
Right.
I go for quality versus quantity of information, and I'll briefly talk about that in the few coming slides.
Great.
Hope I was able to answer the question.
No, great. Thank you.
You're welcome.
Hey,
So
and Al,
yes,
one kind of, I guess, theoretical point too is
yeah,
in trading we're gonna lose, right? That's part of doing business. Part of doing business is taking losses. But
absolutely,
I
absolutely.
view a bad day as in when I don't trade within my system, right? When I let emotions get out the best of me and I'm taking losses bigger than what I intended for the trade. I have no problem taking a loss if it's within my system because that's part of the system, part of doing business. But I get disappointed when I do not, when I trade outside of that system. And that's where bad things to your account happen.
I agree. I agree. Nothing wrong with losses. Losses is part of the game. And I've met people in the past where they're all hunky dory. I got a win rate of 80%. Are you making money? I broke even. Win rate doesn't mean shit, in my opinion. Okay, I shouldn't say that. It means very little, because at the end of the day, it's profits. But the win rate is a metric. In other words, the win rate shouldn't be the metric that people aim for. It should be positive expected value, and the results and the money will come by itself. And there's other things. So yes, I agree that if you lose following your system, you shouldn't be on tilt. Losing is part of the game. You got to learn how to lose. This is not like any other business. Going to your analogy, if you're a salesman and your job is to sell widgets, you're not going to sell widgets to every customer that you meet. There are people that are going to say thanks, but no thanks. I don't need widgets. So and you have to take those defeats. You follow the plan, and it's part of the game. You accept them, and then you go back. I remember as a software developer meeting with potential clients, and I wasn't able to convince every client that I met, every lead that I met to take my services. But that's part of the game. But when I came back from the meeting and I go, oh, shit, it didn't go that well or whatever, or I don't think I'm going to get it, I would think of, okay, what could I have said differently? What did I say? And eventually, what you're perceptive to the body language or the eye contact and or how they sit on the chair and stuff, and you know that you either got them or you're losing them. So trading is the same thing. If you stick to your plan and you don't get the trade, you shouldn't be on tilt. You should be, I'm saying you should be happy, but you take it in strides. And you go, okay, well, if I have a win rate of 70%, or my expected probabilities is 60%, and I lost. Well, okay, it's one of the 40 remaining percent. It's okay. It's when you, like you said, it's when you don't stick to your plan that it should piss you off. And actually, sometimes I'll make money, but I didn't stick to my plan, and I'm pissed off at me. And I go, I just got lucky. That was not. I didn't stick to my plan. I made money, but I got lucky, and I'll sometimes be more pissed on a winning day if I didn't stick to my plan than if I lost on another day, but where I did stick to my plan. I think that's what you're saying. Taylor, did he have to step out?
No, I'm here.
Okay. So is that what you're saying? That it pisses you off if you lose, but you stuck to your plan? You shouldn't be pissed off. You shouldn't be on tilt because it's part of the game.
Yeah, exactly.
Yeah, totally agree. Totally agree. Yeah. Okay. This is already 1 hour. Okay, so it's going good. Good questions. Thanks, guys. Appreciate the participation. I'm going to try to continue with this. So that was the meat and potatoes. And here there's a little more maybe motivational or slides. So it always seems impossible until it's done. Nelson Mandela. So on this screen, I'm showing you my results. These are my interactive statements. If you notice, before Gamma Edge from January to February 12th, so this is about a month and a half, I returned about 20%. And then you can see the dates here, January 3rd to February 11th. And after joining Gamma Edge, from approximately the same period, a month and a half, I returned 47% during that time frame. So I wasn't blowing smoke when I said that Gamma Edge has helped me bring my game to the next level. And I thank you guys, and I think a huge part of this is the community, the feedback from all the traders that are here, and also the metrics and the reports, the morning calls, and the morning status by Taylor and John and James that have contributed to their to the site via their trading, their indicators and skills. So, and I look at my trades. I'm a bit of a math geek, and I look at my trades. So this was based on 26 days, 108 trading days. No, I did get down to a max of 10%. I constantly monitor my trades, constantly. This was my max drawdown, and it took me about 5 days to, it took me 5 days to recuperate this 10%. And if you notice, so this was the 40% of those 26 trading days per day. And so I risked about 2.73% per day, or about 5% per trade. Now, yes, I had a positive win rates, but I don't really, I didn't even highlight them. They're not worth talking. I don't care about them. But there is room for improvement. My standard deviation. So I would have, on a trade basis, I would have swings of 10%, which is too high. Too high. I remember when I briefly worked at a prop firm trading. This is why we never really long-term connected. This was too high. It scared the shit out of them. I would have some swings, and we drifted apart. So all this to say that I kind of know what these firms are looking for. Some of you probably have some experience at trading at prop firms, and they are very risk adverse. They'll have risk managers that keep knocking on, keep calling you, and when the phone rings and you see who it is, it's not going to be good. But so as improvement wise, I try to keep, this is where I need to work on. I need to work on my losses. Actually, not necessarily my losses, even though they're high, like 9% swings on the loss. That's too high. even though I lose more on average, about 5% on a losing trade versus I win 4% on a winning trade. But luckily, the win rate is over 50, so this gives me a positive expected value. Win days, again, on average, when I have a losing day, I'll lose about 3%, 2.7, and when I make, I'll win about 4%, and therefore I have a positive expected value. So these are just simple metrics that I build myself on a spreadsheet to monitor my trades, and because I keep a close monitoring on them, I can, in other words, catch the leak before it kind of no, a gas leak or whatever. I'm trying to use a metaphor. I'll catch the leak before I wake up one day and my basement is flooded, so to speak. The greatest glory in living lies not from never falling, but in rising every time we fall. So this goes to the little motivational aspect. Goes along with the question that Paul was asking. No, I think it has to deal with your personality, your tenacity, not accepting no defeat and stuff like that. So I think of yourself as a professional athlete, whether you're a football, no, hockey player or a golf player. You got to put in the time. There's no substitute for screen time, live trading experience. No, you just got to do it. Keep a trading journal, which kind of goes a bit to what Taylor was saying about treating it like a business. It helps externalize your thoughts and your learning process. It helps. There's some studies that say that writing things down helps with retention. Work on your emotional capital. No, there's more to life than trading. Take days off to heal that emotional fatigue that comes from trading. No, trading is a very stressful job, and you'll burn yourself out. Establish a routine. No, before market open, BMO, and before market. It's not the ticker for Bank of Montreal. It's no. Intraday. No, you establish a routine intraday and AMC. Again, this is not a ticker. It's after market close. What's AMC? The ticker for? AMC Theaters, right? Is that it? No.
Yep.
Yeah. Okay. No, get a good night's sleep. Helps with memory, mood, maintain alertness, and reduces stress. Exercise regularly helps release endorphins, which is like a happy hormone, and well, it's a family of hormones, and reduce cortisol levels, which is a stress hormone, and reduce carbohydrates during the trading hours. No, this has to do with nutrition. No, you need to remain alert. Don't have no your mama's leftover lasagna with 7 levels of cheese and stuff. No, I don't think you're going to be feeling too alert after that. You'll be wanting a nap. So don't think of yourself as a professional athlete. So basic common sense. No, if you want to play pro football, you have to focus on football. Don't try to play football, soccer, baseball, and rugby at the same time. No, focus on football. If you want to be a trader, focus on trading as much as you can. I know that the reality is that many of us have daytime jobs or part-time jobs, so therefore there's a limit to it. But that's the reality. So don't be. And I think this goes to managing your expectations. No, if you're trading 2 days a week, don't expect to get the results of a trader that does it full time. It's just your expectations are way too high. So you basically get out what you put in. And even if you choose to focus on football, example, if you continue with the analogy as a sports, because that's what you want to be a professional, you want to be a professional football player. After a while, you have to choose a position. No, what do you want to be? Quarterback, running back, wide receiver, guard, whatever. Same thing for trading. No, and this comes to your trading style, which kind of segues into the next slide. you have to specialize. You have to specialize on what position you're going to play. What's your skill set allows you to be as a trader. Simplicity is the ultimate sophistication. Leonardo da Vinci. I didn't know this, but I had to Google. I Googled quotes based on simplicity, and I came up with this one. This was, I think, the nice one. Simplicity is the ultimate sophistication. So this is the part of the presentation which is a little more blah blah. I would have left it out, but I was politely asked to include it in the presentation, and I'm glad to. So I'm going to skip over this, and I'm going to limit the lecturing and the evangelizing part of it. Do I think it's the best strategy? Of course, I think it's the best one. Or else, if I didn't, why would I trade it? No, you have to believe in what your strategy is. So it doesn't matter what the strategy is or your thesis. You have to believe in it. If you don't believe it, it's time. You're not going to trade with confidence, and you're going to be eventually losing money because you'll be entering trades too late because you're hesitating, and stuff. So we each have our strategies, but I was asked to share my own, and this is what I'm going to do quickly. So trading style, the KISS principle: keep it simple, stupid. You might want to replace the last "as" by "silly" or something else, but that's how I learned it. So keep it simple, stupid. My thesis is I'm bullish. Why? For some simple facts. Optional notional trading volumes are at all-time highs by some studies. These option volumes provide positive drift to the market. If you listen to Jem Carson and other vault traders, that's what they'll tell you, that all this and I'll explain the next slide. But option notional trading volumes are all-time highs. Passive investment flows add liquidity. All these little apps like Betterment and Wealthfront, where people are investing their extra change. This adds to billions of passive flows, and obviously that adds liquidity, which liquidity reduces volatility. And we know how, as gamma traders, we know how volatility affects the decay of puts, which adds positive hedging flows up to option expiration. The VIX term is normally in contango. That's the basic structure. So again, the contango in the VIX term structure adds to lower volatility. And we know, again, it comes back to positive flows. And we also know, these are facts, IV overshoots, implied volatility overshoots realized volatility consistently by about 5%. And that's where edge comes for those who are option sellers. That's where your edge is. It's in that 5% spread over IV, implied volatility over realized volatility. There's no, okay. So that's my thesis. No, you think big, and then you kind of zoom in. So you're macro, and you're going into micro. The regime, the cycle. You got to ask yourself, what regime are we in? Quantitative easing versus quantitative tightening? No, don't fight the Fed. I just came up with this because it was too long to write. Don't fight the Fed in the slide. It would have made the font too small and whatever. So don't fight the Fed. What kind of regime? Right now, we're in a quantitative tightening regime. Now, you might say, well, you're a bull. Doesn't this go contrary? Yes, it does. But I'm remain a bull, but you have to be aware of what regime you're in. What option expiration cycle are you in? Is it a monthly expiration, a quarterly expiration, or the quadruple witching the yearly expiration? Now, why is this important? We know that the yearly has, like the one in December, has the biggest gamma, and I won't go into the gamma aspect, but there's a theory behind that the bigger the gamma, the bigger probably the pinning effects around the largest levels will occur. So the quarterly and the monthly, knowing which cycle you're in, can help you with your targets and your ranges and your strategy within that cycle. The DTE, are you trading a 0 DTE, 5, that was basically a 1 week, a 2 week, 3 weeks, or 4 weeks. Some cycles have 25 weeks, 25 days. So you got to ask yourself, where are you in here? And the SPX, is it positive gamma versus negative gamma? Are you above the 0 gex or below the 0 gex? So you need to know what the context is of the day in order to help you guide you with your micro thesis for the day. Note, conflicting flows is cause for a pause. The best trade is sometimes the one we don't make. No, as traders, we like to define ourselves as, as traders, we like to justify our, we're used to having 9 to 5 jobs and always working and stuff. As a trader, sometimes trading, sitting on your hands is part of trading sometimes. You don't have to actively trade to justify your job, or your passion. Sometimes the best trade is the one we don't do. But every thesis also has some assumptions. Dealers are short puts, they're positive delta, meaning they're basically long. And I'm talking about dealers. They're long calls, again, also positive delta, and they short futures to hedge, and they seek delta neutrality. So, and again, dealers are short puts, which means that the customer buys puts and they're short calls to finance the long puts. But we're looking at the dealer's perspective. Note, Vanna and charm flows provide positive drift by adding liquidity and compressing volatility in a positive gamma environment. That's the theory. From a ticker's perspective, so if you notice, I go from the big macro thesis, I zoom into the cycle with some assumptions, and now I'm into the more nitty-gritty micro ticker. I'll do SPX 0 DT, and I didn't put a 1 DT because soon we'll be having 5 DTs, 5 0 DTs per week. Starting, I think, they said April, but I haven't heard any news, so I guess it'll be coming sometime soon. Why the SPX? Because it's widely traded and discussed. Gamma Edge discusses it. Paul discusses it every morning in the morning call with slides. The other services discuss it right off the bat, and most of the tools and stuff are around the SPX, Triple Q, SPY, and IWM. There are no earnings surprises. No, it's an index. There's no earnings for SPX. Events are scheduled. The FOMC, CPI, PPI, and non-farm payrolls via a site called Forex Factory. So the possibility of a surprise are limited. The binary events are scheduled in advance, so you can prepare for them. Contrary to stocks where Elon the other day, he says he's going to be on the board of Twitter. That probably sent, I didn't check, but that probably sent Twitter's shares up or down, I don't know. And then he backs off 2 days later with another tweet saying, I'm not going to be on the board. Try to trade Twitter having overnight positions. It's stressful, or at least it would be for me. So I try to limit the things that I don't control, and I try to increase the things that I can control. And these are one of the things because they're telegraphed. Components binary events are absorbed easier. Apple and Tesla and all these are part of the SPX. If one of them have a bad earnings, the SPX will absorb it easier because obviously it's an index, and the Apple is only maybe 6% of the total index and stuff. Only need to learn 2 of the 6 scenarios of the implied order book. If you remember, let me see if I can bring this. You guys see this sheet right now on screen? Yep. Okay. If you notice, this is that famous screenshot one of the pages. If you're doing the SPX, you only need to learn this one with the asterisks right here, and this one here with the other asterisks. So the customer is short out of the money calls, and the customer is long out of the money put. So I just have to learn these two by heart and learn them well, because that is the assumption over here. So again, there's only so much information I can absorb, like a sponge. Mine is a little teeny sponge, so I can't absorb that much. And I like to keep things simple. So that's from a taker perspective. The strategic approach, premium seller. I'm basically a premium seller. Time is literally money in the form of theta. I sell out of the money puts, which I'm bullish, and this goes back to my general thesis here. And what are the positives? I'm positive delta, I'm minus vega, and I'm positive theta. So if I bring this over here, let me try to make this a little smaller. So I'm basically trying to get as many Greeks on my side as possible. If I'm short calls, sorry, I am short puts, I am delta positive. In other words, I want the stock to rise, positive delta. And when stocks rise, the SPX rises, volatility comes down. So I'm negative vega. I want vega to go down. And I'm positive theta. Time decays. And I want that because I'm a seller. Now, the Greek that is against me is gamma. I'm negative gamma, which is not good, because as it approaches, it can have wild swings and stuff. Those who want to be positive gamma, you would need to be long options. But I've been trying to expand my toolkit, and I buy out of the money puts, bearish. Here I'm negative delta, positive vega. I want volatility to expand. When stock market goes down, volatility increases. And since I'm bearish, that's exactly what I want. And I'm positive gamma. I want that gamma. Think about of the acceleration, that speed, that third derivative. You want that convexity. Now, there's different words. You can call it speed. You can call it convexity. You can call it exponential growth. Some people call it kurtosis. It's all basically the same thing. So the goal is to have as many Greeks in my favor as possible. And what's negative against me is time, theta. I'm negative theta. If you notice, I haven't added calls. I think calls is it's not a good thing. I used to sell out of money calls to get some premium, but right off there, you don't get as much premium because there's a put skew. No, the skew is always for the most part, on the put side, as people buy puts. Therefore, the most premium is on the put side, but that you'd have to sell it, and it's a bullish thing. Recently added positive add the money puts to the toolbox. Example: buy to open put call on a rip. You buy on a rip, you buy a put on the rip, and you buy a call on the dip. So that's the goal here. I want to put as many Greeks on my side as possible. That's a strategic approach. From a tactical approach, pace yourself. No, there's supposed to be a hare versus the tortoise. I scale in and out of my trades. I don't go if my 2% is let's say 2 contracts, or 3 contracts, I'll go in with 1 contract, test the waters, so to speak, in case I'm wrong right off the bat. Then I'm only wrong 1/3. If let's say it's 3% and I have 3 contracts, well, I'm only wrong by 1% of my VAR. I'm assuming that obviously each contract is 1%. I leg into a short strangle, I'll leg into a credit spread, and I'll leg into an iron condor. And the objective is 0.4 a day or 100% per year. And this might sound like a lot, but actually this is what this is what was expected at the prop firm. If you did 100% a year, doubled your money, you would be okay. But minimum was 65% a year. And so again, with the trading style, what contributes to all this is the morning calls. I listen to them religiously, but I admit I don't always get to listen to it because I'll wake up a little later and I have to work on that part of my routine. So I'll probably listen to it sometimes at 10 o'clock, which is better than not listening to it at all. The new structure, I love it, with the 1 DTE, the 0 DTE, and you have the yesterday and the previous. And the status gives you a little tailor, adds a line every day to the day of the cycle, gives you a little perspective. I'll use the wing chart. I'll sometimes pull it up several times a day to see what has changed, and I'll use the tick indicator. I think it's very reliable. Today was down all the way. It opened up a little bit, but slowly you start seeing weakness, and it just stayed down. So I think thanks to James that came up with this. I believe so. To the best of my knowledge, it was him that came. And this is in TradingView. And this is basically my TradingView screen. No, I got my tick here. I got the spiders. I got the SPX, and I got the Nasdaq. These are different. These are the levels from another service. We all know. I think most of us recognize them. And these are the trading levels from Gamma Edge. So I combined them, and this gives me my levels. That's I keep it simple. And the VIX, I take a look at the VIX, the VVIX and the VIX. Routine, pretty simple. I like to get the market's pulse on the market. I try to settle in around 8 o'clock in front of my desk. I'll just check some emails. There's something called the morning breakfast from Seeking Alpha. I'll look at the schedule. What's up on the plate today? Is there a Fed speaking? Is it Bullard and Baynard and other Fed presidents speaking? I'll update my trading view with the spot gamma levels. I'll update my trading view with the gamma edge levels. Again, and I try to reply to my emails so I can free my mind on my to-do list. Intraday, I try to focus and limit my distractions. I silence my alerts. I reply to I had to say like emergency emails only, or urgent emails, and I rarely leave my desk. I wear diapers. I'm joking. And after the market, and this is actually probably the most important. After the market close, I'll analyze my trades. The good, the bad, the ugly, and I plan the next day's potential trades. I'll use something like option strat to plan my next days. No, and here's one little quick. Here's Forex Factory, which I mentioned earlier. Tells you the schedule of what's coming up, and that's it. So some basic takeaways: keep your losses small, work on your C game. In other words, work on your losses. Now, we all make money. We can all make money. The problem is that we're also capable, and some of us are very good at it, losing it. So we have to work on the part, the C game, the worst part of our game. If you're a golfer and you're excellent with your putting, but you're so with your your wedges, then what are you going to work on? You don't need to work on your putting. You need to work on your wedges. No, or for those who play golf, keep your trading size small. And this is you can't lose what you don't bet. No, if you don't enter trade, you're not going to lose a penny. So keep your trading size small, build some momentum, capital preservation. You don't have any money, you're not going to be able to trade unless you're working 9 to 5, you have a daytime job, and then you have to put a pause until you get your next paycheck so you can fund your account again. But that's not a sustainable strategy. Limit your drawdowns 5 to 10%. It keeps you in the game and it's easier to recover. Train like a professional athlete, including time to recuperate. No, you need to take a break once in a while. Recharge those batteries, so to speak. Reward yourself for your efforts and sacrifice. Spoil yourself. Now, if you reach your monthly objective, take some money out of your account and pay yourself a salary, just like a business, an employee. Now, if you never pay yourself, it might not feel like it's a business. You might not feel like. I think it helps psychologically to reward yourself. There's more to life than trading. Family and friends. Take the time to enjoy other things, keep trading into perspective. No, we're all blessed as we're doing this presentation. There are people that they wish they were in our shoes. No, they're probably in a bunker hiding, hoping to make it to the next day. So we're blessed, keep things into perspective, and most of all, have fun. I think you guys know that I like to joke, though the jokes sometimes don't get across. And I like to post, have fun with some gifts. That this might bother some people, but we're all here to have fun. If you can't have fun doing what you love, then do something else. And that's it. So there's a bit of food for thought. I'm not going to mention it. I'm going to keep it up here for you guys to read. And if there are any questions, shoot. Taylor, Paul?
We appreciate it, sir. If anyone's got
Okay.
any questions, fire away. I know we've been going an hour and a half almost, so.
Yes, this is longer than I thought, but I cut it down from 60 slides to 23.
No,
I'm joking. No. But there were some good questions, and it was somewhat interactive. So I think, yeah, fire away. Some people are probably, no, I'm just kidding. Or they're too shy to ask. I hope it appealed, it lived up to your expectations, all of you. And I hope that you guys can, even if it's just one slide or a little snippet here and there, if that helps you take your trading to the next level or put you back on track, then I'll feel happy and satisfied that I was of value to the community.
absolutely.
I'll be Velcrush here, so I'll speak up. Thanks a lot. This was very informative.
You're welcome.
I do a lot of the similar things as far as tracking my trades and making sure I'm keeping an eye on that. And I think now that I've gotten to know you better and seeing how well planned you are, I'm really looking forward to being in the room with you.
Likewise, we're a community, so no, it's a small community, and we all have gone through some tough. We all go through some tough periods. God knows I've been there. So if I can help shorten the learning curve for someone or someone else, then it's my way, I guess, of paying it forward. And some people have helped me along the way. So yeah, I'm part of the community. Sometimes I'll hop on and chat and contribute. Sometimes I'm just focused on my trading, so I don't speak during the day, and that's one adjustment I've made. There was a time, it was a one day where I was actively chatting and exchanging with the community, and this was during the power hour, and I think I lost focus, and I ended up goofing up on a trade. So if I don't always actively participate during the day, it's because I'm focusing on the trade, but it doesn't mean that I'm not part of it. I'm just deciding to pick and choose when I decide to speak or share. Thanks for attending, Paul Crush. Yeah, I agree. We both no, we got to know each other a bit from the other place, and we skipped over here. I'm and yeah,
Yeah, no, thank you.
We're moving up the food chain.
Yeah, thank you. And it's interesting because you and I have totally different styles. I'm a swing trader, and only now am I starting to trade SPX. I trade the futures a lot, but I trade that overnight. So I'm not a 0 DTE, 1 DTE, although I'm getting into it a little bit more. But we're like in completely different universes.
And there's not one formula. No, just think of it as a, or I like to think of it as a relationship. No, the same way. No, different couples get along different ways in different ways, and who are we to judge that? No, the way a specific couple decides to live their life is better or not as good as the way you would live. It might not be the same way you would live your life, but it doesn't. At the end of the day, it's happiness. It's what makes you happy. So if it works for them, that's good. Trading is the same thing. You basically have a relationship with the market, and if your relationship works well, trading, swing trading, then and that makes you profitable and makes you happy, then go for it. This is why I wanted to limit. I wanted to choose the subject that was agnostic, which I believe can be applied to any style of trading or any trading relationship, so to speak. There was a bit of debatable, and that was the trading style. So I kind of zoomed by it a little bit, besides the fact that it was getting late. But it's what works for you, basically. Yeah. It doesn't mean that just because people have different styles, it doesn't mean that they can have constructive debates or discussions on the market and stuff. Personally, I know that I might have ADD, no, attention deficiency disorder. I can't stay focused on something for too long, though I've been told but never clinically diagnosed. And this is maybe why 0 DTE is made for me, because it's rinse and repeat. The cycle lasts 6.5 hours. I just need to stay focused for 6.5 hours. At the end of the day, I'm flat, I'm in cash. And the next day, it's rinse and repeat. And since the cycle is short, you get, and I'm only sticking to SPX. I get a pulse for the ticker. It's as if it had its own rhythm, heartbeat, and it's easier to it comes to retention, repetition, like an athlete. How many the professional basketball player that can sink in those 3-pointers? How many shots, how many times do you think he's practiced? Tens and tens of thousands of shots at the hoop. Rinse and repeat, repetition, makes perfection at the and this is why it suits me trading 0 TE, because it's rinse and repeat on a daily basis.
Yeah, I mean, if I were to sum it up, you got to trade your personality, and
Yeah,
if you
yeah.
try to go too far outside your box, you're not going to be successful. And I think your presentation today was just spot on. So thanks for doing that.
Oh, thank you. You're welcome. That's yeah, I agree. No, you have to trade your personality. No, yeah, you have to be self-aware of your strengths and your weaknesses, your personality traits, your skill sets, and you have to be honest with yourself. No, and you have to pick something that no, a trading style that fits, like you said, your personality. Yeah, totally agree. Totally agree. Tommy, I see you're there. You're up at the wee hours of the morning. Maybe it's too. Is Mike? I don't know. Okay, maybe he's not there anymore. But his mic is on.
Well, Al, I don't think we have any more questions, so I think if you're good to leave it there, we can leave it there. We can keep continuing this conversation for those that want to stay on, or obviously throughout the week and whatnot. But Al, we greatly appreciate the presentation and the time you put into this.
Thank you. I did put in some time. You asked me about a month ago, so it took me a little longer. It was a little more work than I thought. I thought it was when you asked me, I can do this in like in an hour, in a week.
Yeah.
But
Yep.
when you start thinking about it, you go, shit, there's a lot of stuff in here, and I had to cut it down. I had to trim it. So, but again, so I hope it lived up to your expectations, and thanks again. Yeah, no, appreciate it. Appreciate
Yeah.
it.
Yeah. Thank you very much.
That's great. Albert, thank you so much.
No problem.